My name is Zixta Martinez. I'm the Assistant Director of Community Affairs and External Affairs at the Consumer Financial Protection Bureau. And I want to thank you all for joining us this evening. It's been an incredibly positive experience for the CFPB here in the Twin Cities area. We're very excited to get this started. I'll do my best to guide us through what I expect will be extremely dynamic and telling discussion about the consumer financial landscape here in the Twin Cities. Let me talk to you a little bit about how this is going to work. First, we're going to hear from your leaders here at the Twin City at a community panel. Before that, Raj Date, the leader at the CFPB, will share some remarks with you. After his remarks, we'll be joined by a panel. Those include Prentice Cox, a professor at the University of Minnesota, Amanda Bardoner, David McGee, and Julie Gugin. But we want to spend the majority of the evening hearing from you. This is your opportunity to tell us your stories. We'll have an open mic session to listen to you and your experiences about student loans, credit cards, mortgages, and other consumer financial products and services. So now I'd like to introduce our leader at CFPB, Raj Date. Raj Date is a special advisor to the U.S. Department of the Treasury on the Consumer Financial Protection Bureau. Try saying that 10 times in a row. He comes to CFPB with tremendous knowledge of financial services through his work at Deutsche Bank and Capital One. He also brings his perspective as a policy advocate. Most recently, prior to arriving at CFPB, Raj founded Cambridge Winter, a nonprofit think tank that injected invaluable fact-based evidence and research that helped to inform the Dodd-Frank debate, which, as you all know, led to the creation of the CFPB. We're incredibly fortunate to have the benefit of his talent and expertise to guide the CFPB through these economic times and through a challenging political landscape. Please join me in welcoming Raj Date.
You're supposed to walk around the other side, giving me time to calibrate again. You jump right up the stairs. Let's bring that up a bit. All right, people should be able to hear that better now. Great.
Okay, well, thank you, Zixta, for that introduction. And before I do anything else, I want to say two things. First, on behalf of everybody from the Consumer Financial Protection Bureau, thank you all for kind of being our hosts here in Minneapolis. It has been, even before now, a terrific day for us, and I think a quite terrifically productive one, and I appreciate that. Second, thank you in advance to our panel, our consumer panel, who will be joining us in a second. You've all done impressive work on behalf of consumers, and you've done that work and you do that work, and we appreciate it. And thank you for joining us. Also, you may have heard that we recently brought Minnesota's own Skip Humphrey on board to join and lead our Office of Older Americans at the CFPB. Unfortunately, and ironically, Skip is not with us in Minnesota today because he is back in Washington, D.C., working very hard to get the Office of Older Americans off to the great start that it deserves. But we are ecstatic to have him on board at the CFPB. So thank you all for coming. The CFPB has been open for business for 97 days. We launched on July 21st, and we launched with a single goal, and that's to make the markets for consumer financial products work. Make them work for consumers and the responsible firms that serve them, and for the economy as a whole. We want to make sure that the prices and the risks of financial products are clear. We want to make sure that consumers can decide what are the best consumer financial products for them. And we want to make sure that there's a level playing field for businesses to compete honestly for consumer business. The Bureau, as you know, and as Zixta mentioned, was created by the Dodd-Frank Act. And it was created in response to the greatest financial crisis since the Great Depression. Before Dodd-Frank, responsibility for administering the various federal consumer financial laws was splintered across 7 different agencies. Literally 7 different agencies were responsible for it, and no one of those 7 agencies had consumer protection as its sole goal in financial services. The result was that no single agency was on the hook for protecting consumers, truly on the hook. There was no real accountability. This was true in the years leading up to the crisis, even as consumer lending was exploding across the country. Big ticket loans and small ticket loans, long-term, short-term, secured, unsecured, everything was booming. And the boom times would never end, or so people behaved. Over a period of less than 10 years, from 1999 to 2007, household debt almost tripled to $12 trillion in the U.S. And as households were taking on all this debt, too often the cost and the risk of that debt was not clear. The prime example of this lack of clarity and the epicenter of the global financial crisis is the U.S. mortgage market. Prospective homeowners were entering deals they just didn't understand because of a lack of transparency. During the housing bubble, it's useful to remember that the fastest growing loans were also the ones that were some of the most complicated. Hybrid ARMs and option ARMs and interest-only loans. These were the fastest growing components of the market during the credit bubble. To properly calculate the cost and the risk of products like that, borrowers would have to have a sophisticated knowledge of things like rate caps and rate spreads and have a perspective on future yield curve shapes. And I know bond traders who have difficulty with all that. So imagine how average consumers felt at the time. This lack of transparency saddled too many people with mortgages they couldn't afford. And now we're living painfully with the consequences. Again, Dodd-Frank created the CFPB to be the single point of accountability for consumer financial protection, whether it's mortgages or student loans or credit cards or a whole host of other consumer financial services. We're looking out for the consumer. Before we even opened our doors, we launched our first Know Before You Owe initiative, and that project was about consolidating the seemingly duplicative federal mortgage disclosure forms. This afternoon, we launched a second Know Before You Owe project that we hope will be the first step in improving transparency in student loans, which is now, behind only mortgages, the largest segment of consumer debt in the country. This project is aimed at assisting the Department of Education in its efforts to develop a simple, one-page financial aid shopping sheet for students and their families. That shopping sheet, that prototype that we've designed, is designed to both clearly disclose the cost and the risk of various student loans and to allow students to compare aid offers from various different schools. We are very happy to be working with the Department of Education to help solve problems in this area. As we go about our job, we will be, and we are already, obsessively data-driven. We are committed to basing our decisions on the best available data and to assembling a great team of economists and social scientists and market veterans to figure out what all that data means. But we know, we're not naive about it. We know that the available data can only get us so far. And that's why we've launched our Know Before You Owe projects, and that's why we're here today. We invite public feedback every day on our website, but we also want to hit the road to talk to people across the country. We're planning more of these town halls throughout the country as we continue to build up the Bureau. The more we hear from consumers from all walks of life and from all corners of America, the better we will be able to do our jobs. So we want you to tell us your story. Your story's good and your story's bad, about your experiences with consumer financial products. We want to know from the public what you think the problems are and where you think we should concentrate our efforts. Your stories will help inform how we work to protect consumers and promote a more transparent and a more competitive financial marketplace. Thank you again for being here, and I look forward to hearing about your
Underserved
experience.
communities. Julie Gugin serves as the Executive Director of the Minnesota Home Ownership Center. The mission of the center is to promote and advance successful home ownership in Minnesota, with a focus on serving the needs of low and moderate income families and emerging markets. And Julie will get the first question. Julie, we know that you and your housing counselors are in the trenches. Can you tell us what you're seeing?
Sure. My organization works with a network of agencies around the state that offer a variety of home buyer and homeowner services, but for our purposes of our discussion tonight, clearly our work as foreclosure prevention counselors is on the agenda. In the last 4 years during the foreclosure crisis, as the crisis started here in Minnesota, we saw quite a few problematic loans and problematic lending activities that contributed quite a bit to the crisis. As the crisis has evolved and as our economy has faced the challenges that it's facing, what we're seeing now are more and more homeowners who are impacted because of loss of job, unemployment, or underemployment, and then usually hand in hand with that are issues related to health care or health issues. So still very much a concern for consumers in Minnesota is the ability to maintain the homes that they're living in now. We'll see fewer foreclosures this year in Minnesota than we saw last year, but the number is still alarmingly high. Our agency worked with 13,000 households last year. We'll work with about the same number this year, and we think we'll probably see close to 20,000 foreclosures in Minnesota. From a consumer standpoint, the number one concern that we continue to hear from consumers is that it's really, really hard to work with their lenders. And we're seeing some loosening of that. In fact, we have some relationships now with lenders and servicers who are establishing local offices which allow opportunities for consumers to meet face-to-face with single points of contact. And that's very encouraging. But working with lenders and services continues to be a challenge. And then finally, what's most troubling perhaps about this crisis is that similar to the predatory loan scams that we saw earlier in the 2000s and even earlier than that, we're now seeing more and more consumers who are victims of scams related to foreclosure, to predatory foreclosure relief activities, whether it's agencies who say, pay us $2,500 and we guarantee we'll get your mortgage modified, or if it's consumers who are being scammed during their redemption period by nefarious folks who offer contracts for deed or similar types of instruments that essentially strip consumers of any of their remaining rights in their home. So that's what we're seeing in Minnesota.
Thanks for sharing that. I would like to say it's a good picture, but it sounds bleak. David, as your clients are trying to access credit, what are the barriers that they are facing, and how have things changed recently?
As Build Wealth works with cohorts of families that have gone through a number of challenges, and we're finding families that have been affected by a lot of the early non-secured credit as they get out of high school and go into college. Before they've even got a job, they've actually accessed credit. We also are having a number of families that are really challenged with student loans. And the access to student loans has gotten so free that they're using student loans almost like a instant cash card in a lot of cases. And so we're finding a lot of families that are first generation credit users. And so there's the issue of never having any information as it relates to what the outcomes and the potential and the damage that credit can actually afford them as they go forward. And so a lot of the families that we're working with not only are faced with some of those challenges, but we're also finding situations where families are able to access non-traditional products that are very high cost, that is stripping them of their discretionary income and earnings as college students, first and foremost. And so they're constantly paying more for everything, in a sense, because of their lack of knowledge and because of the ease of access to those types of products, whether predatory or just now it's becoming almost mainstream. We're finding payday loans and payday lenders as a major issue for a lot of these families, and it's gotten to a point where it's even gotten easier for them to get involved in those, which is literally not only stripping their ability to have discretionary income, their ability to just pay their the bills that are necessities right now. And so payday lending, you normally see a payday lending shop, and that's where it had originally been. Now it's getting to where a lot of our national traditional banks are coming up with payday loans that have sexy titles that are tied directly to their checking accounts, where they'll have a situation where it's tied to an overdraft that will automatically kick in an advance. And so we get into a situation where these loans, not only are they going to be responsible for paying an overdraft fee, they're also going to be paying the high cost of a payday loan or an advance. And this process is getting to be quite expensive for families. We just tracked on Saturday one of the families that in our program. They're actually paying over 2,200% interest based on them being on a Ferris wheel, so to speak, of this process of continuing to churn payday loans. And so we're finding when families have an absence of that disposable income and they've got credit issues as they come out of high school and or never had the education for credit products to begin with, they find themselves in a real challenge. And those are some of the things that we're seeing.
Thank you, David. Amanda, as a statewide chair of Minnesota State University Students Association, what do you see as the primary issues impacting students?
Thank you for the question. I think that students are faced with a lot of issues at this point. Tonight I'll talk about students as a whole. I do represent the universities, but the issue for financial issues are completely relevant for every student across the board. In our system, the average student graduates with $27,000 in debt, and that's just student loan debt. Now, 85% of our undergraduate students are using a credit card. Whether they're using that for their everyday purchase or they're using it for tuition, they're still using it. Now, of those that have credit cards, those are at graduation time have about $4,700 in credit card debt. So add that to your student loan debt and you can see the issue that students are facing. Not only are students taking out, obviously, student loan debt for their tuition and their living expenses while in college, there also is issues between students taking out either those federal loans that they have the option to do or taking out the private loans. And that is a huge rise that we've seen in students taking out the private loans because either they don't realize that they're eligible or that they haven't exhausted their loan options on the federal level, or they just really don't know the system or don't want to fill out the FAFSA because it is a process. And I think those are all issues that our association works to advocate for and also works to educate students because I think that's one of the steps as well. The credit card debt is a huge concern because as students are moving out of graduation with this amount of debt, either in loans or in credit cards, they're not going to have any trust in the system, or will they be able to purchase a home or start investing back into our economy and be smart consumers in that sense. So it really is that you have to start when you're entering college. And this also goes for the non-traditional students. We have a large population of non-traditional students in Minnesota, and the number is only going to continue to increase. We have a huge gap between our educated workforce and the needs for our workforce. And as we try to fill that gap and work in Minnesota, we will have to continue to educate more and more non-traditional students. Now, the problem is that the older you are, the less able you are to take out such risk and high debt. So I think as a state, we really have to work out those issues, and as a nation as well, because it's a trend that's nationwide. It's not just in the state of Minnesota. But how do we ensure that our education is accessible and affordable for all Minnesotans, all United States citizens, and how do we do that? And I think it's a challenge, but it's something that, an answer that we really have to figure out.
Thanks, Amanda. Professor, as a lifelong advocate, as a consumer advocate here, are there other issues that haven't already been identified by our panel that are also impacting Minnesota?
Of course, and thanks for having us here and coming to Minneapolis. The CFPB's authority is so broad, and there are just so many issues that you could address. I think one way to think about it is to think about the fact that a whole large number of people are now experiencing financial distress that have never experienced it before. And they're vulnerable to these downward cycles that other communities have seen already. But the numbers who are in that group have just exploded. And what happens when you get these downward cycles is you get, all of a sudden you're at the most vulnerable position and you face pressure perhaps on your mortgage if you have that, but even if you don't, you face debt collection calls you might not be used to, you face the emotional adjustment of the shame of having to deal with all of that. At the same time, you're trying to obtain short-term money to meet immediate needs, so you get vulnerable to the things David mentioned in payday lending and the downward negative cycles that occur with that, which creates issues with credit repair and credit stores and vulnerability to these marginal entities that suck up a tremendous amount of people's remaining cash, like debt settlement services, refund anticipation loans, and that sort of thing. And so it's not just one problem, but one way to think of it is it's a downward cycle of cascading events. And the number of people who are experiencing that, who've never experienced it before, I don't have numbers, but I'm sure it's at very much an all-time high.
Thanks. David, can you talk to us a little bit about some best practices around asset building, around financial education, anything that should inform the work that the Bureau is undertaking?
Yes, right now, I've been responsible for partnering with a number of organizations, including the Home Ownership Center, but we've designed what I believe is the best practice. It's a long-term approach, a more value-based approach to educating families over a long term that includes a number of different things that where we bring curriculum, we bring peer learning, we bring what I call culturally sensitive training, not necessarily culture by race, but culture by family. And looking at families, what we're the best practice that we're finding is that we're taking families and getting them to go back to the basics of what's important in life. We're finding that a lot of families are out here that have been chasing carrots. They've been looking for life's marketing and consumerism has gotten to a place where people are yearning for things they just can't afford. And a lot of times that focus and those distractions are taken right away from the core of our families. Our program is called the Family Stabilization Plan, and what we do is we get families, first of all, to begin to concentrate on building what we call social wealth, restoring existing relationships, first at home, as in my world is a situation where we have a higher power, and then there's the husband, man, and the wife, and then the child. And what we try to do is get families to refocus on the value of that as opposed to looking at all of the other things. 75% of what we do is based around finances, the car loan, the insurance, the mortgage, and these things are distractions. And when we're not focusing on good, healthy relationships, sometimes the dismantling and the dysfunction of the family begins to take form and shape. And the practice that we do is get families to concentrate on that, get themselves in a place where they can start building healthy relationships and restoring relationships in every area of their life, starting at home, looking at, even with creditors, that's a relationship. If I've got a Capital One card, I've actually engaged in a relationship with the company. And there were some promises there that there's some implied things when we're dealing with our families and with our loved ones and in marriage, but once we start looking at credit, there are terms and there are consequences. And so we're getting families to really take a strong look at building and establishing relationships in every area of our lives. And so when we go and we take out a mortgage, there's actually 77, I believe there's 77 contracts that we're actually entering in, covenants that we're entering in with various companies and organizations and title companies, and all of those are relationships. And so we're trying to get families to look at the importance of relationships and the repercussions of not having a good relationship starting at home. And that's something that we think is a practice, and it takes a long-term approach, not just a Band-Aid where we go and we get a financial literacy certificate. We actually go through the process of learning not only how to restore those relationships, begin to learn in detail these systems that are allowed to work that affect our family. If 75% of what we do are based on these systems, having our family know the intricate details of how a credit system works, how a banking system works, how a housing system works, how a credit system works, is critical to the family's survival. It has such a big impact, and by us not knowing those things, we tend to get in deeper and deeper. And it's a thing about taking that not only as from the surface of what we know now, but replanting that information into our children and into our children's children, so that we begin to break some of the generational cycles of poverty that is just plaguing our families.
David, it's one thing to say I do when you sort of get a sense that there's a lot that goes with it. It's an entirely different issue when you get a 21-page disclosure written in legalese that takes several PhDs to decipher. So you have your work cut out for you.
I do. I think if it gets to that place, and what we're entrenching in the families, if you don't understand it, don't sign it.
Yeah. Julie, can you talk to us a little bit about how you view the role of housing counseling in homeownership? And is homeownership something that we should strive for?
Very good question. The counselors that work in our network are part of a national industry of homeownership education and counseling. And one of the jobs before us as professionals is to try and institutionalize the idea of objective education and counseling throughout the home buying process and into the homeownership process. So a grand vision that we have is that before anybody talks to a realtor, before anybody goes and shops for a loan, they'll get advice from a nonprofit or government-based objective entity that can provide basic information on what to look for when you're buying a home, what to think about when thinking about affordability, and then establishing a relationship that can last through that person's homeownership career. So what homeownership education and counselors do is warn people about the pitfalls and make sure that they're aware of programs and trusted advisors in the homeownership industry that can help them become successful homeowners. What that looks like for each individual household may differ depending on that household's needs, but typically it involves either classroom work or online work, face-to-face counseling, perhaps a referral to a financial counseling entity like what David represents. There's just a whole host of resources out there that we think are critically important for anybody who's either a current homeowner or thinking about being a homeowner to avail themselves of.
Thanks. Amanda, what are the main concerns you hear from parents?
I think it's a really good question. Number one is this a good opportunity for my students to even be going to college? And I think that is really scary when people are thinking about not going to college because they don't want their student to acquire that much debt, or they don't have a way to finance it, so they think they're out of options. I think that's the biggest thing, is that you have to realize that there are options and that there are scholarships and lots of different assistance programs and things, and that just saying no right away is not always the best thing. The other thing that we're hearing is that parents, especially older parents who are sending their kids back to school or to school for the first time, are not in a financial state to be co-signing. And if you can't find a co-signer, depending upon the loan and depending upon the process for that, you then have to either find another way to finance your college education or you're dropping out of school. And unfortunately, a lot of students are faced with making that difficult decision all the time. And some will even try for a semester of putting it on a credit card, or taking out a loan from a family friend, or having somebody that they know co-sign for them. I actually know of a student who approached a professor, and that is obviously not easy for anybody to do, nor is it easy for the person who is being asked. Because what level do they know that person? That's a lot to ask of somebody to co-sign a loan, especially for, if it's a $10,000 loan, that's substantial at any amount for anybody to be co-signing, let alone somebody who isn't directly related to you or a parent. And I think that just speaks to the climate that we're in. For somebody to, number one, to have been able to come up with that idea of asking that person that they really may not know that well, and number two, to have to do that. I think that obviously parents, as supportive as they can be, it's a difficult climate for students. And I think also realizing that when you're in college, the real cost of college is not just your tuition statement. The real cost of college is all of your living expenses, your books, which are continuing to increase in price, and all of those expenses add up. And it's not just your tuition. No longer are the days when I can work in the summer and make enough to support myself through school. 90% of our student body at least have a part-time job. So it's not that they're just relying on loans. It's that they can't do it with working without loans. And that also then is prolonging your graduation rate, which in turn is causing you to take out more loans. And it means that you're there longer. So I think all of these things continue to add up. The biggest thing is making sure that our federal loan programs are available to students, making sure that students realize that you have not, most likely you have not exhausted your financial federal aid, so pay attention to that, and parents just be supportive in that. It can be a stressful process filling out your FAFSA. Some people say that it's easier to fill out a tax form than your FAFSA. I don't know how many of you fill out a FAFSA, but it's a process. And to have to go through a student's income level for 1 year in your tax forms and then add your parents, especially I don't live in the same state as my parents, so that process sometimes is frustrating. So I think it's jumping through those hurdles, realizing that in the end, it's probably better off that you do. You don't want to take out those private loans if you don't have to.
Great, good advice there. You get the last question and maybe the most difficult question, or maybe the easy one.
Well, I filled out a FAFSA form, so I can handle it.
Are there state consumer protection laws that the Bureau should study as we address the mortgage servicing issues, think about foreclosures, or in the area of predatory lending?
Yes. Minnesota has 2 laws that became national models in this area. There was also a bill introduced that went nowhere, but that's a good model. So the 2 laws, one is we passed a law in 2004 dealing with foreclosure rescue stamps and foreclosure consultants. People who go into foreclosure, and Julie can tell you this, can come in with a stack of solicitations that have been dropped at their door, and I mean they're basically hounded. So we developed a law that deals with that problems that arise from that. It was pretty effective, and it's been adopted in like 23 other states and formed the basis of the recent FTC Mars rule. The second thing is, in 2007, we adopted what I still think, and someone I know at CRL still thinks is the best state anti-predatory lending law. Senator Higgins, get your hiney out of the seat and stand up. She pushed it through the Senate. She's here with us, and I think there's a lot of rules in that. We also have a bill that we introduced to bring transparency and accountability to HAMP enforcement by tying it to state foreclosure laws, but that didn't go anywhere. You know what the 2 that we did pass have in common, though? What they have in common, which I think is more important, is that they both arose from information that was gained and understanding that was gained from state enforcement of state consumer protection general laws called UDAP laws, unfair, deceptive acts and practices, which the CFPB has analogous, even better enforcement authority for. And you get a different type of knowledge when you enforce those laws. I think it's absolutely right to be obsessively data-driven, but you're not collecting data on critical points if you don't know what questions to ask. And UDAP enforcement gives you the information about what's happening in people's lives, which then drives you to ask the right questions about where to get the information from. It's a different kind of knowledge, and frankly, it was a knowledge that was utterly trivialized and devalued prior to the mortgage crisis. The people who were working the trenches, whether it was Julie or David or whoever, me, some other people in the audience I see, the people who are working the trenches knew absolutely what's going on. And that information, that perspective, that understanding didn't get much value in the run-up to the crisis, and I think that was wrong.
So this question was easy for you compared to filling out the form.
Yeah, right. Well, right. Or writing the checks, more importantly.
Professor Amanda David, Julie, thank you for your words this evening, your remarks, and sharing the work that you do. Please join me in thanking our panel of local experts. Raj, would you join us? So now it's time for the main event. Now is the time for CFPB to hear your stories. We have a single microphone stand right over here. It's on the right side, in the middle of the room. I can tell you that we've experienced firsthand just how friendly Minnesotans are. So we're going to put that to the test right now. As the line builds and you see that there might be someone who has a hard time standing for a long period of time, we'll see if you let them cut in front of you and speak first. Could you tell us what your name is?
Hello, I'm Sharonda Orich, and I have a few things to ask and a few things to say. Now, when you're talking about educating the people, but you're educating them about a corrupt system. What about dismantling that system so that we can benefit from the system instead of knowing about something and still feeling hopeless, and helpless? That doesn't make any sense to me because these banks are not being held accountable. Now, I had a pick-a-payment loan, and I bought my house in 1997. I refinanced in 2005. I refinanced for $130,000. And then when I got the bill at the end of the year, I noticed that it had tacked on some more because I was paying the lowest. So then it said, okay, I won't pay the lowest. I was paying the second and the third payments. And I was still paying and paying. And then in 2009, I lost the contract, so I went to them because I never missed a day of paying, never missed anything. I went to them and said, look, I'm going to be losing my income, so can you remodify for me? First they said, well, we can't do it because you're not in foreclosure. You didn't miss any payments. So what sense does that make? You want me to be reactive and I'm trying to be proactive. So then after that, I had to fill out, they sent me to, you have to go see a counselor and all this stuff. Well, I don't have any problems with handling my money because I had A1 credit. I never missed a payment. I always paid my bills on time. My grandmother taught me to pay my bills on time, that my credit is my word, and I live by that. But the circumstances, and no one wants to listen to me, no one wants to help me, no one wants to be proactive with me. So then I had to wait until Obama come out with something that would help people who have been paying. And then they still turned me down because I was living off of my savings, which I was taught to have 6 months of mortgage and some emergency money put away. And I did that, but I exhausted all that. I exhausted my 401k. I exhausted everything trying to stay in my loan. I'm in my home, rather. So I'm doing everything that everybody suggests you say you do. I'm doing everything. Everything that you're supposed to do, I'm doing, and I'm still getting no help. Now, fast forward to today, I done paid over $60,000 on a $130,000 loan, and I owe $137,000. The pick-a-payment loan has been banned in Minnesota, but they won't get me out the loan. My home done went down, the value done went down. It's worth $85,000 now, and I'm paying $137,000. And that makes no sense. And they shine a light on people who's been in the predatory lending or who's walked away from their home. But what about the people who's doing, and there's more of us than it is of the people that they highlight that's doing the right things, who's listening to what they supposed to do, who's doing what they supposed to do, and still getting nowhere, getting disrespected. I feel like I'm being raped over and over again, and everybody is blaming me for being raped. And that's not right.
Thank you for sharing your story. There's a lot we can learn from that. And there are some experts in the room. Are you working with one of Julie's housing counseling group here in the Twin Cities area?
I'm tired of housing councils, all that stuff. I'm doing what I'm supposed to do. I save my money. The only thing that will help me is that if they redo my loan. I have no
Got it.
money problems besides.
We hear you. Thank you.
Hi, my name is Cheryl Downey. My husband and I, for over 15 years, were, like her, impeccable with our mortgage payments, as well as all of our bills. In 1992, when we bought our house, the mortgage was perfect. We could afford it. There was nothing untoward about the mortgage that we bought. Our struggles began when my spouse lost his job as a hospice chaplain back a month after the initial breakout of the bad mortgage loans crisis in 2008. It impacted the financial structure of the hospice he worked for nationally, and it closed its doors in a month. So that started our dealing with the problems that the mortgage loans had brought us. So he started piecing together work, and it kept us afloat but underemployed until 2010, when unable to make our full mortgage payments, that started building debt for us, and so that put us on the fast track to foreclosure, and we got, the process server served us foreclosure papers 2 weeks ago. It's very emotional. It's something to stand in front of people and talk about something that is kept so private, because that's just not what the middle class does, and it's not what we were taught to do. And it's like we've done everything we can, and it still falls in our lap. And we have to fix it somehow, but we don't have the resources to fix it. Now, it's one thing if someone loses a job and the economy is growing. It's another thing to lose a job when it's not. And so we look around and there's nowhere to go, and yet we're left holding the basket and bearing the brunt of having to make this thing work when it's completely broken. We were thrilled. Plus, we've resubmitted our paperwork like half a dozen times to the bank. They've lost it twice. And they keep saying if you pay an increased amount of mortgage payments for 3 months in a row, we'll reevaluate you. And no, you're not on the foreclosure track. But that's happened 6 times now, and they keep saying we're not on the foreclosure track, but we got our process, the process server came up. We have a date, the end of November, and yet they're saying, so to me, that keeps us, what do we do? Do we go this way or do we go that way? We can't do anything. Are we in it or are we not? And it's like I feel nulled by it, and I don't know which direction to go. We were thrilled when Obama came out with remodification money. We thought immediately, okay, this is going to help us. We haven't talked to a single banker in all this year and a half. Supposedly we have somebody who's ours, but we've never talked to him on the phone. We've made several attempts. We don't even know if this person exists. So it's just, I don't know. Come November 22nd, I don't know if we're going to have our house or not. The added piece of this is that, of course, our credit's trashed, and my daughter, who is a very intellectually gifted child, who graduated from high school with 2 years of college under her belt at almost a 4.0, can't go to college because we can't complete a FAFSA. So it's all just mushrooming, and, we're one of hundreds and thousands of people like this. So to me, if I could just throw out one constructive idea, because we're in the crisis we are, if the banking system, I know that there's a lot we have to learn and there's a lot I didn't know, if somehow there could be a time of resilience, because, for instance, two of my husband's employers for his contract work, the person who cuts the checks was on vacation, didn't have anybody covering his work. So we didn't get the paycheck that we needed to pay the mortgage on time. That happened twice. And yet, from the bank standpoint, we're just negligent, and it adds up, and pretty soon we have no recourse. So if things could shift up a little bit, at least for this time period, to allow us a chance to keep at it, rather than just shutting the doors. Thank you.
Thank you. Thank you for sharing that.
If you don't mind, let me just just react really to that comment and the one before, which is mostly just say thank you. Like it is, it's not a comfortable thing to talk about one's personal finances, and frankly, that's part of why it is that, you know, it's hard to get through these things sometimes, because this is a colossal problem, and frankly, it took a surprisingly long time for people to start internalizing just how big and how pervasive it was. And it also, frankly, it animates, and I'm quite sure that our entire team in Washington is right now remembering exactly why it is that they work 80 and 100 hours a week. It's because these are big problems. And the reason why most people end up somewhere around the consumer financial businesses is because they want, at some level, because they know that this stuff is supposed to make life better. Mortgages are supposed to make life better. Student loans are supposed to make life better, and there is going to be a day when that happens again, but the first thing that has to happen is it's got to stop making life worse. But thank you, because it helps inform all of it.
We got a call from the president's office of Wells Fargo wanting to work with us. But it took 2 years of nothing, and then never responding to us. And that's the major problem. They don't want to deal with us.
Great. Thanks.
Hello, my name is Camille, and I have roughly $10,000 in credit card debt, and then I'll be graduating with altogether probably over $30,000 in student loan debt. Before I turned 18, I was offered a lot of credit card offers from a couple of companies, but a lot from one certain company. And I'm a first generational college student, and so my parents really didn't have that, experience of funding for college. And my mom had advised me to get a credit card for emergencies, so I did that. I would charge, once I turned 18, I would charge a couple of things here and there, and then once I got my statement, I would pay it back. Well, and my dad lives in California, and so it was really hard because he said he would help me, but with mailing a check and everything, it was really hard for me to get money from him, and he said he would help me, like usually within the first week of school, we would have to have our balance paid. I went to a different college for a semester, and before school started, we had to have the balance paid. And so, I was stuck, so I had to charge my car, charge my tuition on that. And then my laptop broke down, so I need to get a new laptop, living expenses, and everything like that. And I feel that the credit card company was very misleading because it targeted it to college students. And maybe a year after I got my credit card, they're like, oh, how's college, how's this? And it's just ridiculous that they target it to college students, and 20% interest rate, like you had mentioned earlier this afternoon. Once I graduate, I'm going to be having my diploma in one hand and student debt in another, and it's just ridiculous. So
Thank you.
Good evening. My name is Pete Barry. I'm a private attorney here in Minneapolis. I'm a consumer rights attorney. I sue debt collectors. Tonight, my law partner, Nick Slade, and I are celebrating our 15th year as consumer attorneys here in Minnesota. What I want to tell the people in this room is I've been teaching law school. I'm an adjunct professor of consumer law at William Mitchell College of Law, and I've been teaching for 10 years. And I've done sort of an ad hoc survey of my law students and asking them about their levels of student loan debt. And what I'm finding is as each year passes and as tuition increases, there are greater and greater levels of student loan debt. It's very common for me to talk to students in my practice suing debt collectors with $250,000 in student loans. Now, there have been people that have been in our office that have had over $300,000 in student loan debts, and there's a bankruptcy attorney who's in our office who recently visited with a client who had $452,000 in student loan debts. The point I want to make is simply this. Professor Cox alluded to this earlier. For a decade, I have thought that the next shoe to drop in this economy would be student loans, and I think we're starting to hear that. We're starting to see that from President Obama in his response to it. I think we're starting to see it in the Occupy Wall Street protests, that student loans are the single greatest issue, because the people who are engaged in that kind of indentured servitude, economic servitude, to the student loan collectors and the student loan servicers and the student loan originators, they don't have houses to worry about. They don't have mortgages to lose. They don't have foreclosure to worry about. They've got student loans to worry about. So I wanted to bring to your attention an article that came out. It came out on the 20th. This is from Inside ARM, which is Accounts Receivable Management. I'll give a copy of this to your aid. But it says, and I quote, and this is by an editor of the leading trade publication for the collection industry, for Inside ARM, and it says, student loans, the ARM industry's new oil well, ? And in the article, they highlight the fact that student loans cannot be discharged in bankruptcy. Not just Department of Education loans, all student loans. That's in all caps. Yeah, I didn't know that either, but hey, somebody has to pay the bills. And then he goes on in this October 20th editorial piece that appeared in the Inside ARM, he goes on to say in that article, the great part is, once again, you gain a sufficient amount of experience collecting on the student loans in the private sector, you may be able to obtain a subcontracting relationship with an existing Department of Education servicer and ultimately win a contract. They are bragging about the fact that we are enslaving students going forward. The people who aren't going to have mortgages and aren't going to have to worry about foreclosures are going to have to worry about $1 trillion in non-dischargeable student loan debt. And frankly, I don't make a penny on what I'm telling you, and couldn't care less from a personal perspective, because I don't have student loans. I've been fortunate, I've been very blessed by my community to be able to pay my student loans off. But when I sit and look at law students who are sitting in front of me, and collectively I've got 10 law students with $2.5 million in student loans in the room for law degrees they're not going to be able to use, that's a very serious problem. Even more serious is the predatory behavior of an industry that's now geared up to target over the next decade, and this article details that, over the next decade, they're going to target student loans. They're going to target the fact that they're non-dischargeable, that there are co-signers, parents and grandparents and family and friends who are going to co-sign on these loans and who have essentially foreclosed upon their own future. So I'm going to leave that article and those comments.
Thank you.
Hello, my name is David Corrigan, and I'm here with the leadership of the Minnesota State College Student Association, the sister organization of the MSUSA, and I'm also a student at Anoka Ramsey Community College. We've been hearing a lot about student debit cards or campus debit cards that are supposed to be a way to get financial aid out to students faster, which sounds great, but unfortunately they're hidden with a bunch of fees and a lot of ways to avoid consumer protections. Is there anything that the CFPB can do about that?
Well, I'm going to broaden the question a little bit, if I may, which gets to my mind, one of the great features structurally of the CFPB and why it is that I'm glad that Congress designed the Bureau in the way that it did, which is, in the past, it was literally true that consumers had to rely on knowing whether or not their provider of a debit card product or otherwise happened to be a national bank or a thrift or an industrial loan company or a state-chartered bank or a state-chartered Fed member bank. And you know what consumers usually say about that? Who cares? Why does it matter at all? Why should there be different rules for different things? Now, it just so happens that the Bureau now has, and when we have a director, we'll have comprehensive authority across. It doesn't matter whether it's a particular new channel or a particular new twist on an old product. We'll have the authority to make sure that everybody plays by the same set of rules. And we take that responsibility and that set of authorities quite seriously, and I think it should help.
Thank you.
Hello, my name is Shannon Glenn. I'm a student at Anoka Ramsey Community College as well. As a college student, I put educational expenses on my credit card. Now, there's so many students in the state that do that, and I know that important legislation passed last year in DC to create credit card protections, but I've heard that they may not be enforced. What can the CFPB do to protect those students using credit cards?
The CARD Act that you refer to is one of the federal laws that transferred to the CFPB on July 21st of this year. So this is the 97th day that we actually have had authority to supervise the largest banks in the country with respect to compliance with that law. And what we've learned over time, I think as a people, we should have learned over time that having the right laws on the books is not enough. You've got to pay attention to make sure that the law is being complied with, and when it's not, that it's enforced. And in the appropriate circumstances, we're not going to be afraid to do that. So thank you.
Thank you.
Hi, my name's Molly Glasgow. I'm a resident of North Minneapolis, a small business owner, and also a member of the Northside Community Reinvestment Coalition, and CRC. We're a group of Northside residents that work to maintain and build community wealth and also to prevent foreclosures. And we find a lot of times that people will come to us and they've already been through the whole foreclosure counseling process, and the banks are saying, no, we can't do anything for you. I certainly know that, and we've heard tonight, that there are so many hoops that banks give us to jump through on any sort of issue. Being self-employed, it's near impossible for me to get a loan, whether it be for my business or for a home. But with foreclosures, we see people coming and banks refusing to offer modifications. And then once as a coalition, we take on a specific case and contact the bank about this person, either getting letters, going to the bank as a group, doing phone calls, something along those lines. The resources are there. And finally, just as the Downies said, when there was an article published about them, the bank said, "Oh, let us work with you. Let us make ourselves look good." But unless someone has the community behind them, that doesn't happen. And it doesn't happen as often as it should. So that certainly speaks volumes to the efficacy of organizing, but it's not a sustainable model. And so looking for real solutions so that people who want to stay in their homes and can stay in their homes can find modifications so that we can make that happen.
Thank you. Thanks for your work.
Hi, my name is Ross Abbey. I'm also an attorney. I went back to grad school for a J degree in age 28. Over the course of 3 years, I racked up more than $120,000 in student loan debts. And the earlier speaker kind of stole my punchline. My situation is not a worst case scenario. I'm actually a best case scenario. Because unlike a lot of today's law students, I had a chance to work at a law firm during my 3 years. I got to go to a top 10 law school, and I got a good paying six-figure job coming out of law school. So 5 years later, I thought I would be totally paid off. I've actually only paid off 2 of my 4 loans, and I still pay $600 a month for years to come. Like I say, I'm actually a best case scenario. My question for you guys is, and what I worry about is the law students. The legal industry has shrunk by 10 or 12% since the Great Recession, plus new technologies coming online. So a lot of these current students are not going to have any job, let alone a six-figure job. So what is the obligation on law schools, and what is the obligation on student lenders to disclose the actual, the actual job market when you get out? We've got law schools that are still advertising 90+% rate employment rates for the graduates. Second point related is, I think at the base of a lot of the student loan issues is the fact that higher education costs are inflating well above inflation. And next to healthcare, it's probably the highest inflating cost in the country. And I wonder if part of the reason isn't because student loans are so available, and so you've got all this money flowing into the system, allowing schools to just increase their rates ever more. So I'm not advocating ending student loans or cutting off that path to people who aren't from wealthy families, but how do we untangle that inflationary spiral that we seem to be in. Thank you so much.
Go ahead.
My name is Jeff Skrinas. I'm the housing director for the Hawthorne neighborhood in North Minneapolis, and also a member of the NCRC group that Molly spoke of. I want to pick up where she left off. What happens in a community after the foreclosures, after we haven't stopped enough people from losing their homes? And the tidal wave of foreclosures in Hawthorne is receding, but that's really only because there isn't much left to foreclose. We haven't stopped foreclosures. And what happens then? You've got blocks and blocks where the majority of houses at some point have been boarded and vacant or foreclosed or demolished or some combination of those things. You've got limited access to credit means that the average person can't find the type of loan necessary to fix up and rehab those houses, and so your buyers are essentially the city of Minneapolis to demolish them, nonprofits to do the rehab, or the next round of slumlords and predatory investors coming into the community to prey upon us. And then what happens is you've got decreased property values, so even everybody who has been fortunate enough to stay in their homes, when they need to make a big repair, a new roof, a new furnace, those types of things, even the best types of credit or the best types of assistance that the Hawthorne neighborhood has to offer people require a lien on the property. Even if there's no payment required, there's a lien. And people say, I'm already $30,000 underwater. Why should I take on more debt when even if I don't have to pay it back, even if I just stay in my home? So we really need this Bureau to, number one, to stop that, turn off that spigot of foreclosures and get more people into loan modifications. We need better access to credit so that these homes can be purchased and rehabbed by individuals on their own. And I want to emphasize, stop the spigot of foreclosures, because if the banks can be pressured one by one by organizers to stop a foreclosure and do a loan modification, then the resources are there to do it. They're just not using them, and that's where we need you to come in and do it systematically. Thank you.
Thank you. Thank you.
Hi, my name is Dolores Lafayette. I'm from Brainerd, Minnesota, Crow Wing County. I do fraud and scam seminars for AARP. And every time I do a seminar, I hear horror stories about financial institutions, what some of the seniors are going through. A couple of just one-line statements that I just want to bring attention to is interest-only loans, I think, should be illegal. I know someone who took out a $25,000 student loan, interest only. This person has an 810 credit score and cannot refinance anything to start paying that down. Why is this even allowed? Why do we even allow interest-only loans? What's the point other than the bank is making money? Junk fees. Also, I spent 15 years in the real estate industry in Crow Wing County. The closing companies hated to see me come to a closing because the first thing I would do would be take the closing statement and I would kick out about $200 to $300 to $400 in junk fees. $85 courier fees to walk across the street to the courthouse. Things like this need to be addressed. The fees have gotten out of hand. Our lending institutions are out of control. They need to be revamped. Banks refusing to work with people. Communication within the banks. 8 calls in 2 days to one person that made a 2-week late payment. First time in 23 years. 8 different people in 2 days from the same bank. That's ludicrous. Why is this happening? One story that I just would like to share from someone that we're still working on. This has been going on for 2.5 years. Party was 2 payments down, kind of had a turn of bad luck. 2 payments down, called the bank and said, when my 3rd payment is due, I'm going to mail that in with my late fees. Please tell me the total amount so I can send it all to you with the third payment. 3 days later, this person was served with foreclosure papers instead of a payoff figure. Attorney fees and foreclosure stopping fees came to almost $4,000. They paid it, decided they really didn't want to mess with the bank anymore, was able to gather enough money to pay off the home. Called again and said, what is my home payoff figure? I want to just pay it off and get away from you. They put the home into foreclosure again, and there weren't even any late payments. That took about 6 weeks and another $5,000 to stop that foreclosure. It's been 2.5 years since that home has been paid off. To date, there has not been a satisfaction of mortgage received yet. When they have been called, they say, well, you have your receipt, don't you? This is not how we do business in Minnesota. This needs to be stopped. The lending institutions need to be revamped from the inside out. A lot of them are corrupt. A lot of them are just disorganized and taking advantage of the consumer. And I'd like to see a lot of it stopped.
Hi, I'm Joe Brothers, and I have another issue, but I don't know why you can't just defer your payments if you're in foreclosure, or even before you go into foreclosure. You know, some of these people seem to be playing by the rules. Why can't they just defer their payments for a certain length of time? You know, there might be one solution that, you know, maybe you come up with, and I don't know if the banks will be willing to do that. But another issue I have is how do we prevent the Wall Street banks from taking over the Consumer Protection and Financial Bureau by having a person at the top, or even people within the regulation, being a part of the banking system? That's my number 2 thing. So how do you prevent that from happening as citizens? And my number 3 thing is, my issue is on credit cards. I want to know, I want more transparency. I want to know how much the shop that I'm purchasing my goods from using a credit card is being charged to accept my credit card. And I want to go back to credit, being able to use a check if I want to. Okay? If I should, by choice, if I want to use a check, I should be allowed to use a check so there's less transaction cost to the consumer of using that, if that's if that's applicable or if that's actually true. Those are my 3 points.
If I might, let me just spend 30 seconds talking about something which otherwise doesn't, frankly, it almost never gets asked, and so I thought I'd take advantage of the fact that it has been asked here, which is, I think, the second of your 3 questions, which is about the notion of what's sometimes called regulatory capture, this slightly, pathological but predictable means by which regulators who are meant to protect, consumers end up being more sympathetic to the interests and of the largest institutions that they're meant to be supervising. And there are all kinds of reasons, and I'm not an academic person, but there's quite a bit of academic literature about how it is that it happens and why. Starting something new is a gigantic pain in the neck. However, it does give you certain advantages. And one of those advantages is you can build the place in a way that makes it resilient, not immune, but resilient to those kinds of pressures over time. And I'll give you one example, because it's the most visible about how we've designed the place, is the fact that we're here right now. It is very easy to huddle in your little office in Washington, D.C. and forget that the rest of the country exists, and that's exactly how it is that you kind of forget, I think, who you work for. And we are not going to let that happen here. But thank you. It rarely gets asked, and so I just want to take advantage.
Hi, my name's Chris Anderson. I am from Occupy MPLS. Today I think you raised an excellent point. When you start something new, it's a gigantic pain in the neck, and it's slow. Today we did have a woman who got a call from U.S. Bank, and they gave her 2 weeks to keep and continue negotiations. Anybody else here, we're reaching out. We have our first GA Saturday, too. We want to talk to all the neighborhoods. We got over 70 neighborhoods in Minneapolis. We got to come together. Now, the reason I say that is because skeleton architecture. This is another federal program that is, for lack of better language, policing financial markets. I'd like us to change the paradigm. Educate the people. Let us stand up for ourselves rather than continually having to run back to another federal organization that is supposed to protect and enlighten us, educate us. Because, I mean, I did want to say, as another gentleman has spoken to, this is a cultural issue. As Mr. B. Barry said, he mentioned the words indentured servitude. I remember hearing them in a book I read by Dr. Ronald Takaki called A Different Mirror, Multicultural of American History. This is a predatory system. It's a largely and blatantly corrupt system, and that's why I would hope that you would educate us, the people, those who maybe did or did not get their GED, who are struggling through school and non-traditional. I mean, for me, I'm a non-traditional student back at the University of Minnesota, very blessed to be there. But I took a couple years out to make sure that I can actually be at a place where I am not. The people that you see here are the tip of an iceberg. And the amount of turmoil that this creates and that this perpetuates that continues to fracture our communities will never allow for there to be a sustainable solution, because this is a systemic issue. So educate us and help us bring our communities back together. OccupyMPLS@gmail.com, OccupyMPLS.org. Get it done. Thank you.
Thank you.
My name is Jake Metz. I kind of offer a perspective on both sides of the coin. I am a recent graduate from University of St. Thomas, finance graduate, but I also am a teller at apparently the hated Wells Fargo. I am definitely a punching bag, but I promised some customers that I would come here and also career opportunity as well, and I'm really interested. But I would really like for you guys to elaborate on what you're going to do to restore this trust with banks, because I see it every day where I really want to help people, and I do, but sometimes it's really hard for me to take my education and financial knowledge and break it down to those people, which is exactly what you guys are trying to do. And best of luck for that. It's going to be a tough journey. But if you guys could elaborate, on your main points of attack. I've heard simplify, I've heard transparency, and I've heard educate. Is there anything we can look forward to in the near future?
So, first of all, let me express I'm sympathetic to your plight. My last paying job was the senior investment banker at Deutsche Bank, covering large cap banks and thrifts in the United States during the financial crisis. So I know something of going from a bit of a pariah on these issues to trying to be productive from a policy point of view. You're going to see a lot from the Bureau. We are still building out, and we do not yet have a confirmed director. But we are open for business, and all of the authorities under all of those laws that transferred to us 97 days ago, we are quite serious about supervising compliance with them, enforcing them when they are broken, and making sure that there are sensible rules of the road that honest business people can serve customers who actually need the finance system. Consumer finance is important. It is the life, whether you like it or not, 60-70% of the economy is consumer spending. And consumer spending depends on consumer finance, and so we've got to have the system work again. And that means trust, and that means rules of the road. And you'll see rather a lot from us over time.
Thank you.
Thank you, everyone. I'll just add a couple of final words. We're going to do our part. There's a lot of people in this room who are already working hard and doing their part. We're in this for the long run, and I want to thank you for sharing your stories with us. We take them back. It matters a lot, and it's very important for you to continue to keep up the work that you're doing in Minnesota. And thank you for spending your evening with us.